Yeah, hi. Good afternoon. Can I have the presentation, please? Yeah. So I know it's a tough time. So I think I will take around 15 to 20 minutes, given that it's just approaching lunchtime. So I will talk about, instead of hunger for food, a little bit of another topic called hunger for profits. And the reason we can say that is that we manage in Marico a digital portfolio of a run rate of 250 crores, not GMV, but net realization, because that's what we have to look at. And we believe that we have now managed a certain burn rate which is 75% lower than similar size companies operating in the same space. And at least a significant portion of our portfolio should turn profitable in the next 12 to 24 months. And therefore, what we will just talk about is our thesis on how strategic partnerships can actually turn a sustainable, profitable growth. Okay. So I think one of the things which is very, very popular is the question of valuation. Now, we have a different premise, which is basically, if you chase value, valuation automatically happens, as opposed to chasing valuation. And therefore, I think value creation, which is a very, very important thing, which we focus on, and we believe automatically value creation happens. So this is one premise change. The second premise change, which I'm going to talk about, is that ultimately we look at founders who believe in building to last. And if you have an approach of building to last in a business, automatically you can sell and have the valuation, as opposed to having a starting point of saying that I'm setting up a business to sell. And if you really look at it, there's the first stage of the business where a founder has a very strong passion, a great idea, and is extremely passionate. Having said that, after you hit whatever, a run rate of 3-4 crores, 3-4 to 5 crores per month, if you don't start believing in, looking at a sustainable business, and I think to me the 100 crores is the first, perhaps the hurdle, and after that it's much more smoother, I think you will not be able to build a sustainable business. So therefore, there are incubators, but there are people who are both incubators and institutional builders. And I think that some of the people whom we have bought business from, and we follow a very simple policy of investing 51% right now. We have done minority investment like in Beardo, and then we work with the founders, leave them alone for 3 years, and we have an earn-out this one. But we look at people who actually are institutional builders. And they can become serial institutional builders if you really look at it. And I think build to last model is something which is profitable, repeatable, and scalable. I know these are boring words, but I think it is important that even in this kind of a startup environment, you can be boringly consistent in having what I call a profitable, repeatable, and a scalable model. So I'll come to what are the pillars of a good business? And this is a starting point, which is a good incubator, 0 to 100 crores, or 0 to 50 crores to be precise, in terms of net realization, which translates into 100 crores in GMV. And the first is obviously a great differentiated idea, which is fulfilling an unmet need. If it is a Me Too product, it doesn't have that scale. It will last. And let me tell you something, maybe between 20 and 22, when everything was, whether it's investments, whether there was a huge natural tailwind towards e-commerce, D2C, a lot of not so great ideas also got some traction. But I think right now it will be a little more difficult because both funding will be choosy and consumers are going to be choosy, and the fact that the natural traction, which a lot of e-commerce boom that happened during COVID, which led to a lot of tailwinds, that has quietened down, but still India has a huge potential. So I think what will happen is, the stronger and stronger business models perhaps will have a far better chance of doing better than somebody with not a so stronger business model. The second thing is product market fit. Obviously, pricing. A lot of times you have a great idea, but the addressable market is so limited, Or, for example, if you create a food product or a juice which is 6 days shelf life in India, it's very difficult to sell, okay? So I think, so a great idea, but the addressable market is limited, the pricing is way off, or it doesn't go through that supply chain. Third is obviously founding team, and I think a lot of times a founding team are pairs or 3 people who have invariably different skill sets and competencies. I mean, if I have seen successful founding teams, somebody with a farm of front-end marketing, consumer insights, digital marketing competencies, somebody wanting to understand, I mean, somebody proficient in supply chain, manufacturing, somebody understanding, cash flows, and this one. I think in the founding team, they need to have a complementary kind of skills, which is important. And lastly, we look at sound fundamentals of a business. And when we look at a lot of investment ideas which come to us as a strategic investor, and this is something which we first look at, as a business has sound fundamentals or not, which is great product, and I will come to it, that what is the characteristics of a great business for a scale-up. So if you look at some of the levers to take the business to stage 2, and a stage 2 means, in our opinion, is anything above 50 crores, which has the potential to hit 200, 250 crores and onwards. I think the first thing is having the right portfolio. I think a lot of times, and one of the things you must look at in a right portfolio is, do you have 50% of your business coming from 5 to 6 hero SKUs, which gives you sequential growth of 4 to 5% every quarter. And every year, can you add 1 more to that hero SKUs list? Because that is your steady business, which becomes profitable early on. And it could be, if it's a service business, can you have, say, 30% or 40% of your outlets that actually give you steady business and they break even. And it is also extremely important that that set of business is a strong business which has repeat customers, which has, acceptable, what I call a kind of a franchise to it. The second thing is, please never compromise on product quality. And as founders, I'm sure all of you do it. I think there are a lot of insights that come from 3 sources. One is the reviews, one is the complaints, and the third thing is continuously looking at your early adopters or your loyal set of consumers. And I think product quality, sometimes people feel that if I have a nice brand name, very nice packaging, it doesn't matter product quality, anything sells. But believe me, fundamentally, whether it's a food or a personal care, whether it's product efficacy, in the case of food, it's taste, in the case of a service solution, it's the quality of service, customer experience, or even the returns experience. If you are selling an electronic product, I think the entire returns and this one experience. I think product quality, don't think just if you can be a great, this one in digital marketing with the perfect ROAS and everything, but if the product quality, and therefore, please look at whether it's, coming back to that portfolio, that 50% of your hero SKUs, are they consistent bestsellers? Are they consistently rating top quartile in your category in the, all the e-commerce sites in the, where you are selling it? The third thing, of course, is the quality of digital marketing and consumer insights and this one. Fourth is, I think, extremely important is unit economics. And please don't neglect the unit economics from the start, because if the gross margin to start off with your CM1 level is not there, it will never happen, unless there's a pathway to it. And to me, if you look at it, unlike in a brick and mortar business, where you can manage spend controls, like for a quarter, and manage your profits, in a digital business, your spend is directly related to your sale, and therefore you can't do profit management. And therefore, fundamentally, if you don't start with your CM1 right, like for example, in our industry, unless you have a 70% CM1 in personal care, one of the reasons food struggle in e-commerce, it's much better to do, in a brick and mortar, is the AOVs are lower in foods and the gross margin lower in foods. The perfect business model is actually, I'm just giving you a broad, this one for a personal care, we have modeled, if you want to break even, as a 60-70, gross margin with a 40% ACOS at 100 crore plus with a 12% fixed overhead. Then you deliver profits. And believe me, that can only happen when you have a ROAS of a 4.55, which is best in the class in the industry. And right now, there are only 1 or 2 companies who have hit that model. And I think in our portfolio, I think Beardo is on the way to do that. Now, if you don't do that in all the three, and therefore you have to start correcting both for the gross margin and for your digital marketing efficiency and this one, and it's an iterative process. If it doesn't happen simultaneously, profits will never come. And one thing is there that in this case, destiny, you can't believe in destiny or God because they will not help in doing the profit. It's to all of us. The other is people. I think it's very important that I understand all founders. But after some time, at least 100 crore plus, you need certain people. And I think it's important the people are equally passionate about it. It's not about getting what I call marquee people. I think one of the things that we have seen a lot of, say, consulting people, CPG people doing the crossover into the founding thing. And one of the things, what has succeeded, and I was talking to someone, that some people have succeeded, some people have not succeeded. And I think the biggest reason is they come with a set of capability, which is obviously they bring to the table. But I think what is most important is ability to work in an uncertain environment without system support. Because when you work in large organizations, sometimes you undermine the support system which you get in the organization. That actually how many decisions you're taking. And in simple thing like, the kind of support, large MNCs have in terms of their global this one. So therefore, it's extremely critical having people who can work independently in a uncertain environment, manage complexity, volatility, and what I call hustlers. You need hustlers. Hustlers with capability and functional capability, and that's the kind of people you need. But it is important to appreciate that, yes, you guys are great, but someday you need help. And there is nothing wrong in seeking help. And therefore, I think the right people in the bus as you hit the 100 crore mark is extremely important. I know founders, innovators don't like this word processes. It's a dirty word, bureaucratic. But the way I believe in process, and I think Marico is a very great example of a process-oriented entrepreneurial organization, is that if you have good brakes in your car, you can actually ride at 120 miles per hour. Of course, you shouldn't try it in the ceiling. That is dangerous, and you will obviously get some tickets. But, and therefore, some processes are important. To give you an example, I would talk about 2-3 processes which I look at from a 0 to 100 crore journey for any company. The first one is extremely important, is that do you have an SNOP process? And I'm sure all of you understand SNOP. And SNOP manages inventory, and it manages working capital, it manages write-offs. So any good business should have a basic element, and today there are enough off-the-shelf automated processes available, cheap, okay? The second thing, obviously, is an innovation process. And the third is, in a lot of companies, especially in high-value items, if you are having AOVs, your customer returns and your customer, because that is where leakages happen, and also a lot of customers, dissatisfaction happens as handling entire customer. I don't think at this stage you will need much more complex processes, but these 3 processes are actually extremely important to start setting up some processes, Lastly, I know e-commerce has huge potential, but ultimately, the next scale up, if you cross 100, 150 crores, it's not that entire portfolio has to go to it, but I think in certain businesses, this you have to go to omni-channel to do the next set of scale up. And there, I think this is one capability which is important. I think see what has happened is that in digital market, in the e-commerce space, the entry barriers are far lower. I can have a great product, I can do discounting, pricing, I can have the best-in-class digital marketing capability. But when it comes to omni-channel, the capabilities are different. And therefore, as you start hitting a 100 crore mark, I think it's important to start thinking of omni-channel. Some of the other categories like food and all, I would say much earlier. But I think you need to have that omni-channel capability. And in there, I would then introduce one more process, which is there, is that if you really want to succeed in omni-channel, is to have how do you manage channel conflicts? Because if I have a pricing and a discounting level in e-commerce, which is at a certain level, and then I decide to go to omni-channel, if I don't have what I call a pricing discipline or a MOP, it is set for failure. your movement to that omni-channel or brick and mortar, because that will never succeed. So I think these are the broad thought processes which we have. This is something we have converted into a playbook. And as I said that we strongly believe that we have a broad playbook to actually scale up profitably some of the businesses. Now, just the last topic, before there's a last slide I have, that all of you, after some time, has a choice for a strategic buyer versus a financial buyer. And what does a strategic buyer brings to the table which a financial buyer doesn't give you? First thing strategic buyer gives to the table is a guarantee of a capital for the next 3-4 years. You don't have to run every 6 months to make presentations and do pitch document, okay? So that's the peace of mind you have. Now, culturally, we are good at it, working with founders because of our mindset. So therefore, obviously, certain strategic buyers may be control freaks. We are not, because in our culture of empowerment, we extend that empowerment and the same culture to the founders. Having said that, I think strategic buyers have 4 things which, or 5 things which I believe have far more value proposition to this one, especially now, when there is a little bit of what I say, funding is not an abundant thing. First thing is, I think they have a far more long-term vision on the business. They want the business to succeed. It's not about short-term. And I think you cannot compromise the long-term for the short-term. The second is strategic buyer has intimate knowledge of the industry, and therefore they can add value. The third is access to ready infrastructure. For example, all our 4 digital brands which we have on our stable, we recently are doing a concept of, we're having a house of brands philosophy, and we see anything between 500 to 800 basis point cost efficiency if they share things like logistics, if they share things like CRM and other things. So there's a huge cost advantage which we have, because we are a house of brands as opposed to one single brand. And we are a house of brands at 250 crores net. It will go to 500 in the next 3-4 years. So therefore, there will be significant cost synergies. I think access to people, processes, and the interesting thing is that we don't charge or cross-charge for people, whether it's my time, anybody's time, and that, I think, helps. And lastly, I talked about synergies. I think we believe that the way I see our Marico digital business is we'll have, say, 8-10 entities maybe in the next 2-3 years, all having a common synergy, common playbook, common way of doing businesses, but each at a different stage, some run by us, some run by founders. And that creates a far more surer path to profitability. And I think, as I said, that when we look at a 3-year earn-out model, it's like a blank check. Obviously subject to this one, a certain disciplined way of growing, because as I said, for me, vanity comes in growth in top line and reduction in burn rate, and not necessarily how much burn rate. And I think that's the mindset shift a lot of us have to do on that. So that's it. I'm happy to take any questions. Couple of minutes. Any questions, I'm fine. Yeah.
Hi, sir. My name is Archit again. I think you mentioned one of the points that founders are very important, and there are a set of 2 founders or 3 co-founders you have generally worked with, and everybody has some kind of expertise. And I've been questioned from a lot of people multiple times that it's not investable company because there's a only founder. A lot of VCs have also mentioned this to me sometime, that because you are the only founder. Do you think how strong this point is, and do you think it's a big barrier for scaling? Do you have any example, or you think what should a sole founder really do moving ahead? Should he completely be dependent on finding a co-founder to scale to that 100 crore, 250 crore, or do you think it's doable with the right? So I just wanting to get your comment on that part.
So I don't think it's a formula for it. Of course, it's interesting that all the businesses we have invested in has 2 founders. Okay. Now, usually it helps because I think, as I said, that 2 different people sets 2 different sets of competencies. It also creates some kind of a maker-checker, some kind of a challenge in it. I think it helps because ultimately, it's lonely at the top and uneasy lies the head that wears the crown, So I think it's important to have 2-3 people, but it's not a magic formula or something. But it is extremely important to have that honest assessment of, unless you are a complete all-rounder, that there are certain things you like doing, certain things you don't like doing. Like for example, I met somebody who, it's a large company wanting to someday take IPO, and this person says that, listen, I don't like doing supply chain, I don't like doing all these SNOP, but they're important to you. Then even if you don't have a founder, get somebody on board who is good at and likes doing some things which you don't like doing. So even if you're good at everything, there might not be certain things you might not like doing.
VCs who invest, or is this
so
just a reason?
I think it's important that we assess the founders, between the founders or in the organization, there's a requisite set of capabilities or competencies are not there or not there. I think that is a criteria ultimately, because you're betting on, in our case, for example, we are betting on the founder team to take the organization, because we are doing a very loose oversight. We only look at capital, we look at compliance, regulatory, reputation, risk, and portfolio. The rest we don't look at. So we are betting on them to take the company to the next stage. So therefore, it is important that all the competencies exist.
Hi, you hear me?
Yeah.
Hi, Shagata.
Hi. I just had a very simple question. What should your balance be when it comes to profitability and getting high turnover, especially when you want to go for funding? So you need to show growth month on month, quarter on quarter, but it comes with obviously, reducing your profits. If you really want to show a nice trajectory and want to impress, but what should be the balance? Like, do you always look for people who are getting good growth month on month, or people who are sustainably growing with even less amount of profit for that matter?
So, like I said, I am not a PE, I am a strategic investor where I am also answerable to my investors, because it's a capital allocation. For me, it's a capital allocation, whether I do a strategic invest in this one, or I do it organically, or I do 100% M&A. But I think I have a different point of view. It's not an or, it's an and. And therefore, at every stage, after every 2 years, I think one should do a pause and reset to say that, are we on the right path in terms of profitability, at least a path to profitability? And as I said, it comes with unit economics. The unit economics, if it's not fundamentally right, today all I can do is I can look at this and I can tell you will ever make money or will not make money, irrespective of the quality of the slides or the pitch deck. I think that much knowledge, I think we have been able to, and that everybody does. And I think it's important that, as I said, that at a certain stage, it's okay, profits don't matter. But at least, do you know the levers of driving up the profitability? I think that much, it's important to know. So it's not that and therefore I would think at any stage it's an and, depending on the situation you optimize and give weightage to it. I would never give a 100-0. In fact, our earnouts are based on a 60-40 formula, which is 60% on top line, 40% on bottom line, subject to all other things, discipline. For example, how much market credit you have, how much of the last 3 months, what have you done, dumping or not. So we have a fair formula on what to look at. And we want to take over a healthy business. That's about it. Yeah.
You spoke about omni-channel in stage 2. How important is it to establish omni-channel in stage 1, where it's just going from 0 to 100 or 0 to 10?
So it depends on, usually I think like the reason I said in FMCG foods, which has a slightly lower AOV, maybe lower gross margin, start getting into brick and mortar might make sense to start off. It's not formula, but ideally, I think your ability to learn, be agile, continue experiment, high velocity innovation, digital offers you far bigger opportunity to test and learn continuously. In omni-channel, in a brick and mortar, so I would still say that you must first perfect the business and then go to it. And even there also, for example, in Beardo, I think we only sell very few SKUs. We don't sell the entire lot there. But omni-channel is different. You are with traditional players who have perhaps better capabilities there, but you might have a certain prohibitive cost structure. So I think it's better not to do it in stage 1 until you get a critically proven business model and do the crossover. I'll take one more because I have to rush. So.
Hello.
Yeah.
Hi, I run a brand called M Caffeine in personal care, and one of the questions which we try to keep on answer for ourselves is, Joe, I think somebody asked growth and profitability, and there is no either or, there is an and. But at what stage we should evaluate the rate of growth of the company is to the market? If the market is growing at, for example, we are in a category which is growing at 12%. As a challenger brand and you leave that tag beyond a revenue stage, how should we index from that point? Because that drives also a lot of things. You probably take a decision on unit economics, brand building, distribution, right? So what is that right revenue mark according to you, or right indexing industry is to your growth? I mean, your as in our growth.
So if you are growing at 2x the category, it's fine. I mean, see, I think the only thing is we should know that how much percentage of your business is tactical, and it is just based on tactical discounting and you'll never get it. As long as you have other healthy metrics, for example, your CACs coming down, your ROAS is improving, your say Amazon, Big Basket, your Flipkart reviews are good. You have so I think that it's a combination of A plus, B plus, C plus D of a healthy business. Your returns are controlled. I think as long as those parameters are continuously improving, you can keep on increasing the run rate, nothing like it. But one thing shouldn't happen, that I do it oblivious of the fact that these things don't matter. Or even if it doesn't matter to you, at least look at those numbers and you are aware of it.
Got it. Thank you.
Simple question, sir.
Yeah, I'll take this as, yeah, okay, last.
Yeah. Can you hear me, sir? This is Divij from Power Gummies. I just had a last question, a simple one that a lot of us were wondering. If we have a business that tick boxes everything that you have said, how do we reach out to you?
Please, always you're welcome. I mean, just email, and we are always accessible. So we are continuously working. And I think, let me tell you, my biggest this one is that of speaking to all of you is it has been tremendous learning for me personally and my team. And I think one of the reasons it has also helped us in this model is I think it has significantly improved our own personal and our team's digital quotient by interacting with fantastic people like you. Okay? Okay, thank you so much.